Hi, here we are, finance videos again, everybody's favorite YouTube channel to visit. We are talking about working capital management, which is sort of the second topic in the first unit of our basic finance class at Keene State. And we're going to be talking about sort of on the ground what actual finance people actually do in sort of small businesses. And, this is just very practical and straightforward managing your cash. Remember, finance is all about finding ways to manage cash in such a way that you can maximize the net worth of your business. And so, managing your cash from a real operational standpoint is it's very, very important and very real, very sort of on the ground. So this all kind of flows out of the idea of your budget. Um, Budget management is an important aspect of a financial manager's job, and we spent a lot of time in managerial accounting talking about building budgets, looking at your relationship of your various expense categories, and thinking about going from figuring out how much you're going to sell next year, next month. That drives then how much you need to produce, which then drives how much you need to purchase in terms of raw materials, how much labor you need to schedule, and how much of your overhead, your manufacturing overhead, needs to be allocated to this particular aspect of the production. At the same time, your master budget is going to have a selling and administrative expense budget, or as we think of it, sort of operating expenses that are below the cost of goods sold. Um, and then that gives you your budgeted income statement. Are you going to make a profit? But what we're interested with finance is we're interested in cash. And so to get from an income statement budget to a cash budget entails a little bit of maneuvering. A little bit of maneuvering in Excel, because you don't always pay for what you buy at the same time that you purchase it. Moreover, you have to pay for what you buy, your raw materials. You have to pay for them long before you actually get cash receipts from the sale. You don't sell every item that you make with cash either, right? So the difference between when you receive cash from a sale, when you pay out for your raw materials purchases, and then later on, actually, in this class, we'll talk about capital expenditures and how that goes into a budget, but that's sort of beyond what we're talking about now. But just the difference between your receipts, getting your money from your customers, and your payments when you pay your suppliers, that gives you a cash budget, which derives from your sales budget. And so the first example problem is just walking through a spreadsheet application that shows you how that's going to happen. So I got to close out a PowerPoint here and open up MyLab and Excel and show you how to do that. Okay, I'm showing you how to do this because it's super important sort of as a practical matter when you're doing financial analysis to construct your spreadsheets in a certain way. So I'm going to show you how to do this in a way that allows you to have them be as flexible and useful as possible. Okay, so right now over here in this setup over here, we've got a lot of blah blah blah, right? A lot of talk, a lot of words, and we want to take those words and put them in a format that we can analyze, right? So what I'm going to do is I'm going to have a whole section over here in the spreadsheet for assumptions. So there's going to be a whole section over here in the spreadsheet about assumptions, which are those sort of hard-coded elements that flow into a financial model that you can change if you need to. So, if you want to pursue a career in finance, you're going to develop a whole portfolio of financial models, and you can adapt them to whatever the situation is, as long as you make them flexible enough to be able to be adapted, right? So the key, like best practice in spreadsheet modeling, is to keep your inputs or your assumptions separate from your calculations. Very, very important. Okay, so here we go. So we got Myers and Associates, a famous law firm in California, bills its clients on the first of every month. Clients pay in the following fashion. Okay, 40% pay at the end of the first month, and 30% pay at the end of the second month, and 20% pay at the end of the third month, and 5% pay after 4 months. Okay, and this is their current situation. So this is our current situation. Okay. So the new finance manager is going to be focused on collections, and they are going to, let's see, get 60% pay at the end of the first month, and 25% at the end of the second month, and 10% pay at the end of the third month. You will notice also that that I'm ignoring these uncollectibles, because that just means that your cash is never going to get to you. You're never going to see it, so it does not go into a cash budget. Okay. So what will the new cash flow with the change for the first quarter of 2015 be if the new system takes effect in January? So let's make another assumptions that new starting in January, but payments for the prior quarter will follow the old pattern. Okay. Okay, here we go. So the first thing we want to do is get our data in. Okay, and I'm going to place this data in column B. All right, so these are our billings for the fourth quarter and then for the first quarter of the coming year. And what we want to know, right, is how many people are paying us. No, you know what? We got to put it on a row down, and let's leave a blank row to keep ourselves straight. So we want to know when people pay us, right? So on the 1st of October, they billed out $392,000 of billings, right? And so at the end of the first month, we got 40% of those billings. So let's put in our our row headers here. Okay, so I'm just going to copy and paste these cell values here. Okay. So now, okay, I'm going to take and get rid of this other page so that you have a full screen of just me in Excel. Okay, so here's how you do this. In October, 40% of the customers are going to pay their October bills. The bills go out on the 1st of the month, and 40% of them are going to pay them that month in October. All right, so let's set that up. 40% of this month's billings. Now, if I want to just copy that over for November and December, because remember, things change in January. If I want to just copy that over, I get a value error. And the reason is because I forgot to use an absolute cell reference here for this 40%. Because remember, it's always going to be 40% for those first 3 months anyways, right? So let's go ahead and make this A4 an absolute cell reference. We can copy that over for November and December, and it will work. This is now 40% of December's billings. Now in January, the pattern changes for the first month's billings. In January, we got to pick up 60% now. And we can make that an absolute cell reference while we're at it. So in January, it's 60% of January's billings. And we can copy that now out to March. So that takes care of the people that are paying this month. They get their bill on the 1st of the month and they pay it by the 30th of the month. Okay? What about the people that are paying from last month's bill? What about the people that are paying in November the bill that they got at the beginning of October? Well, it's 30% of them, right? So 30% of people in November are going to pay their October bill. Or, put it back the other way, 30% of the people who were billed in October are going to not pay it until November. Okay? So we do the same thing. We pick up that 30%, make it an absolute cell reference, and multiply it by October's billings. And we can do that also, pull it out for the rest of the year now. In December, they're still paying for November's billings, right? And so based on this assumption here, payments for the prior quarter will follow the old pattern. That means that we have to take this out one more quarter or one more month into January, because in January, people are still going to be paying December's bills. But now in February, they're going to be paying January's bills. So again, we can make that an absolute cell reference. Multiply January's billings. And copy that out to March. And in March, they're going to be paying February's billings. And you follow the same pattern, right? So in December, you notice also that this is sort of a staircase pattern. Right? You're not going to be able to fill this in all the way down for October because we don't have the data from the past. Okay? But in December, there's still going to be some people paying October's bills. 20% of them. Again, using the absolute cell reference. And pick up October's billings. And again, we don't switch it over until we're talking about picking up January's billing. So I can take that out the 3 months again. So in January, they're paying for November. In February, they're paying for December. And now in March, they're finally going to be paying January's bills. So we can switch to the new pattern. And then likewise, right now we have to start down here in January. In January, people are still paying for October's sales or October's bills. So we pick up that 5%, those deadbeats, 5% of the super slow pays. And we can just copy that out. Now this only has to go for the 3 months because in March, they're still paying for December. So we don't have to switch to the new pattern here. Okay. So if you add this up, total collections, and we'll make those bold. All right, starting in January, pick up all the cash payments, 377. Copy that out, and that gives you the answers, which you can go ahead and put into MyLab. So that, my friends, is how you do a cash budget. Isn't it fun? I love this stuff. All right, I'll stop this video here and make a new one for the next stuff.